AI is moving fast. So fast, it's hard to keep up. In fact, in ServiceNow's latest AI Maturity Index, scores dipped 20% from last year. But that's okay, because AI isn't a sprint, it's a marathon. You may be behind today, but tomorrow you could be a pace setter. Dive into ServiceNow's AI Maturity Index and see how you can innovate as fast as your ambitions. Visit servicenow.com/AI maturity.
Reality radio for a really great future. We're talking real money.
I'm trying really hard to be optimistic, and there are so many reasons to be pessimistic about growing older. But the one thing that's good about it, the one thing that's really good about it, is the perspective it gives you. Hello, everyone. Welcome to Talking Real Money. I am Don McDonald in your Talking Real Money Florida studio. Tom is in the, people wonder where it is still, the Duval, Washington auxiliary
People come
power
by
unit.
here all the time. They come by here. The APU is on and operating for the moment.
Welcome to the program. We're so glad you're there. If you'd like to call us and ask us questions, this part is easy. You just call 855-935-TALK, 855-935-8255. Getting the other stuff right can sometimes be a little bit more complicated because of the way our brains work and the way we're wired. But what is it I'm talking about when I say us old guys got an advantage over you youngsters in that we have perspective? And I'm talking about the whole idea of, let's think back to the 1990s when we were getting into the internet was becoming this gigantic thing, and technology was taking over, and a lot of people thought, this time it's different.
Yeah, and they said so, and they invested that way, and how did that turn out?
Then in the 2000s, later in the 2000s, 2007 with real estate, remember? Real estate can go to $500 a square foot because, well, folks, this time is different.
Yeah, and how did that work out for you, too, if you borrowed a lot, leveraged up, and purchased a number of properties you couldn't afford?
But now with AI and it eventually putting all of us out of work so that we'll just be on the government dole, is it different this time?
Yeah, I mean, it's staggering to think the number of times you've heard that. And by the way, the author of this article, Allison Schreger from Bloomberg, says, well, yeah, okay, people have said that phrase is overused and should be ignored. Well, except
for now.
This time. Yeah, for now. It might make sense
because of course,
pay attention.
This time is different.
Yeah, it is. And she cites not just AI, by the way. And AI is, of course, the topic du jour when it comes to the future of employment, business, etc. But she also mentions, and I love this one, increased financial fragmentation.
Increased financial fragmentation. You are going to have to tell me what the heck she means by that.
Well, I think what she's referring to is markets for a while looked like everything was kind of going up and down at the same time, both in terms of the size of stocks and in terms of the countries, et cetera. And now that's changed, right? Because this year, international stocks have made way more than U.S. stocks. And smaller companies aren't doing the same as large, et cetera, et cetera.
Wait,
so
that's fragmentation? That's fragmentation?
That's what she's saying.
Well,
yeah,
wait,
integration.
Is she 12?
She didn't cite her age in this article.
Didn't the international markets do really well between 2001 and 2010?
Yeah, well, she doesn't talk about that.
But
what
wait
she
a minute.
does add,
but was it
yeah,
different and fragmented then?
I don't know. What she does add is the third big change.
Yeah, what is that?
Which is higher debt and inflation environment. That means less stable correlations with the stock market, et cetera, et cetera. I mean, these things will play a larger role.
Did she forget the 70s? Well, apparently she wasn't there for that one.
Didn't we faced this a little bit in the late 2000s, right? 2007 with the meltdown.
But
right?
didn't we have high inflation after the oil crisis and on into the early 80s? Didn't we have double-digit inflation?
I think my first mortgage was 14%.
Yeah. Huh. So, wait, what's her argument for it being different this time?
AI.
Wait. Okay.
And?
Then let's do this. Let's do this.
Okay.
Hold on.
Please. Yeah.
I just want to check it out.
Check out AI?
Is
See
the
if it
market
works?
different this time because of AI?
AI definitely has the potential to reshape the market in some pretty significant ways. It can drive productivity, create new business opportunities, and definitely influence valuations. But it also comes with a lot of uncertainty and volatility. So while it might feel like things are different, some of those good old investing principles still apply.
Oh, is that the woman who's taking my spot? Because
That's
I'll just
the
go
woman-
back out to the
that's the
dock.
woman
if
who's
you don't
taking your
mind.
spot.
I'm ready. It's
Hey,
75 here in sunny.
She was a lot better than I thought. That was pretty darn good.
She sounds better, too. So,
Oh, her
yeah.
voice. Yeah, it's great.
Beautiful.
This is
Yeah.
what gets me about AI, is that all of a sudden, they don't sound like AI.
No,
anymore.
like computer, as they once did.
I mean, in 2001, it sounded more like a computer.
Okay, but let's get back. So if you buy into what Ms. Schreger is saying,
Yeah.
AI, fragmentation, higher debt, what do you do with that information? How are you going to respond to that? How are you going to fix your investments to deal with those things as they're coming at you today?
Well, that is the $64,000, $640,000,
Showing how old you are again.
$6.4 million question
Yeah.
that we've asked over and over again every time we claim there is something different. And that is what do you do about it? And the reality is you can't really do anything about it except keep doing the same old boring stuff that we're doing, which means why are we reading Bloomberg Business Week?
Well, okay, but going back to what our friend at AI just said a moment ago, yes, it all may be different, but the same principles still apply.
Right.
I love that.
Right.
Pretty smart.
Yeah, I mean, because you don't know if it's right or not. That's the problem. You don't know the future. 855-935-TALK. Give us a call.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Good old Talking Real Money, the traditional broadcasting talk show, and at the same time, one of them newfangled, it's different this time, podcast things.
Hey, that was well done. Well done, sir.
We're a little bit of everything for you, as long as everything is money. If everything isn't money, then we're not everything. But we're everything money and mainly investing, because that's where you guys get in the most trouble, because you're human and we do dumb things and we think dumb things and we read dumb things and we write dumb things and we just kind of act emotionally. 855-935-TALK is our phone number. It is 855-935-8255. And looking at the screen here, I see, yes, no one has called. So
No, that's
we're at 0 calls right now.
Go back to the AI lady, I guess, huh?
Well, I could,
she's
but
very
I'm not
good.
going to. We're going to
Say,
use her.
do you
We're
have a
going to use
question
her
for
later.
Talking Real Money? Okay.
We're going to use her later.
Oh, yeah.
I got some ideas.
Okay.
Anyway, we're talking about it being different this time, how things change. And it's interesting. In addition to that Bloomberg article, there was an article today, Saturday, in the New York Times by Jeff Sommer about what he considers to possibly be the bigger risk than a market meltdown, and that is what he refers to as a market melt up.
Which I'm not sure I could describe well. I mean, it's sort of the idea that stock prices are going up because they're going up.
They just won't stop going down. They just,
you said down. They won't stop going up.
Because for some reason, we've got it in our heads that no matter what happens, they're going to go up, so it becomes a self-fulfilling prophecy. However, as part of that assumption that he's making about the melt-up, there's no downside to that until the meltdown, really.
Yeah, I mean, but he points out a couple of things that are pretty interesting, and if you want to be scared, you could be pretty frightened by them. Points out, for one thing, that shares of companies that are making no profits have been rising faster than those that are deeply profitable. In other words, he points out a company that's in the Russell 3000. I think it's Avia Technology. I don't know if I misstated that, by pardon. But it's up 500% this year, and of course it's losing money, although it makes sensors for robots, autonomous vehicles, and drones. Those are things people want to think a future is all about. But he calls this an unsustainable dynamic, something that really can't continue.
Yeah, he calls it that, and he talks to people at, of course, investment firms for his background for this article, but they all like claiming they know the future because their business model depends on you believing they know the future. But the reality is they don't know the future. And what's most interesting about this story is that Mr. Sommer says in the article that basically he's not going to do anything different than he's doing right now.
But he waits until page 4 to do that.
Why are we bothering with an article like this again, unless there's something you can do about it?
Yeah, I mean, he does point out a couple other things I think are interesting, sort of discussion. NVIDIA, as you know, hit the $4 trillion market capitalization this week. That's astounding. Yeah. But I forgot, as part of that, its price to earnings ratio is 50-1. That means you're paying $50 for every $1 of the company's earnings.
At least it has earnings.
As I just pointed out, the other one
does not. There's a whole bunch that don't.
500% this year. So that's, I mean,
we're
Irrational exuberance decided.
We're betting the hope line on those.
Yeah, exactly. And then I think he talked to somebody who said the estimated range of subjective probabilities for the stock market. 60%, this is like predicting the weather, 60% chance that the bull market will continue, 25% chance of bear market caused by a recession, and a 15% chance of a melt-up, which I'm going to have right after the show, but that's a separate thing. But doesn't that sound like kind of what the market, that's kind of what it does on average, right?
Here's what's funny. Yeah, exactly. There's a 60% chance of it going up until it goes down. And there's a 25% chance of it going down, which it will eventually do right before it goes up again.
Yeah.
So
I think it's waiting for you and I to retire, then it'll go down a lot. There's your lesson.
The correct bet is it's going to go up and it's going to go down.
There you go.
But historically, and this is why I say, really, we should, Jeff Sommer, the woman at Bloomberg, us here on the radio, we shouldn't exist. There's no reason for us to be here if it wasn't for your emotional stupidity. No offense.
Well, except that Jeff points out that, and this is a direct quote, any provocation or disruption could set off a severe downturn.
And you'll know it after it already has happened.
Oh, that's right. They won't call you ahead of time.
Does he anywhere in this article say, and you need to do this to avoid it? Did he say that?
He makes a request. He says, it'd be far better if markets were calm and orderly, so I'm hoping we have neither a melt up nor a melt down, a traditional bumpy market with setbacks, but an upward arc is in nearly everyone's interest. That's pretty much true. So.
Dude, that's just lazy writing, in my opinion. That's just lazy, because why do you make more money in the stock market than you do in the bond market? Now, which has the smoother, less volatile upward arc over time. Has had. Which of the two, stocks or bonds, has had the smoother, steadier, less volatile, less scary upward arc between stocks and bonds? Which one in terms of returns?
That would be the bonds,
the
fixed
bonds.
income.
Right. They
IOUs.
already provide that. They provide that. But they also have made a whole heck of a lot less money. You have made more money by investing in stocks because they're stupid and irrational and scary and appear dumb at times. That's the risk part. It's important that you understand that fact about investing in equities. You can wish for a nice, smooth equity market, but if you get one, you won't get returns. Am I missing something?
You've been paid to take the risk. If you properly diversify, and we'll talk about this another time, you can reduce some of your risk there because so many stocks go way down in short periods of time. And that diversification, again, has paid you less than being in a VIA that's up 500% this year. A VIA, pardon me.
Oh, and there was one other thing he mentioned in his article that I wanted to mention. He says, quote, only occasionally, in my view, I'm glad he added that, is it completely obvious that the market is so high that it must fall or so low that it must rise? Jeff, have you ever effectively played that completely obvious hunch that you had successfully over and over again? It's not that obvious. It's only obvious, and if he was completely honest, he would say this. It's only obvious in hindsight.
Yeah, most of the time people can't see what's going to happen next, and they are jaded by their own views, their history, and as you said, their emotions that can drive really bad decisions.
By the latter more than anything else. And that's why it points out, that's why he points out and we point out that the best way to do it is to pretend like you don't know the future, which is actually the case.
Tom and Don are talking real money.
The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. Central Texas Regional Mobility Authority is using Google AI to create smarter tolling systems and improve traffic flow for Texans. This is a new era of American innovation. Find out more at g.co/American Innovation.
For your real life and real future, Tom and Don are talking real money.
Welcome back. I'm Don. Tom's over there, and our phone number is 855-935-TALK. 855-935-8255. It's money that we're discussing, but it's you that is really the most important part of this, because we're trying really hard to show you what works and why it works and what doesn't and why it doesn't, and help you avoid some of the pitfalls and the big mistakes that we know are being made regularly when it comes to investing and managing money for both your retirement, your longest-term future, your kids' college education, buying houses, all the things you do with money, earning that money, and not getting ripped off when you give it to somebody else for some future purpose. 855-935-TALK, 855-935-8255. There is also another way for you to send us questions. That way is to go to talkingrealmoney.com and either speak them, those get answered on the Friday show, the Friday podcast, or type them and they go into this massive basket filled with paper. I don't know how they go from your fingers on a computer to paper. I don't understand how that process works. But Tom always has paper right there in his grubby little hands.
I think we could say I always have paper. Rich from Hot Springs Village, Arkansas writes us, "Gents, love the podcast. Find your info very valuable. Recently, I used Portfolio Visualizer and looked at 3 portfolios, each comprised of U.S. stock and global stocks. It means international. Mm-hmm. The data going back to 1986. The first portfolio, 50% U.S., 50% international. The second was 75% U.S. stock, 25% international. The third, 100% U.S. stock. These portfolios were set to rebalance annually. The result was the heavier weighted U.S. stock portfolios
Wait, let me guess. I guarantee over that time frame that the U.S. stock portfolio destroyed the internationals.
He didn't give us the numbers, but yes, and he goes into Kager, Sharpe, and Sortino ratios, which I think is pretty deep. This seems to make the case, according to Rich, for heavier or total weight in U.S. stocks.
No.
He goes into some other things here about all this, but what say you? Because returns have been better, especially recently with U.S. stocks. Why would I own those most difficult international firms?
Let me use another analogy for you. If you had, over that same period, invested in small cap value stocks, I don't have the numbers for that period. Actually, I do have them going back to 1926. If you had invested in the entire U.S. market versus investing in U.S. small cap stocks, you would have small cap value. You would have made. Let's see, what's the number?
It's an almost 4% a year difference.
Yeah, you would have made it's about
a lot more.
You're about a 40% higher return.
Yeah, it's
about a 40% higher return. So why weren't you just in small cap value all of that time?
Yeah,
there's a reason. See, we don't suggest international for its additional return potential. That's not why. Otherwise, we would tell you, don't have bonds in your portfolio. They make less money. We don't know when the U.S. market is going to do well and when it is not going to do well. And we don't know that going forward, the U.S. market was the preeminent market for the last 60 years, 80 years.
Well, especially since the Great Recession of 2008.
Yeah.
Been very dominant. Yeah.
So just because it has worked doesn't mean it will. And the problem is when it stops working and the other ones start working better, you're going to want to jump in after the fact, which is generally too late.
Well, you see that this year already. International stocks have far outproduced U.S. stocks this year.
And that's not because we said invest in international because we knew they were going to be better.
I think it was. Yeah.
I'm not paying any attention to him anymore. I believe that we invest to build the right portfolio for us, for each of our individual situations. And you cannot focus on whatever the hottest thing has been, even if it's been the hottest thing for 40 years. That doesn't matter. That's not what we're looking at. We're not looking at past performance being indicative of future results. We're looking at diversification, protecting you.
Tom and Don are talking real money.
The McDonald's snack wrap is back. You brought it back. Ranch snack wrap. Spicy snack wrap. You broke the internet for a snack. Snack wrap is back. Ba-da-ba-ba-ba.
For a really great future. We're talking real money.
This is the show that helps you know more about what you should be doing with your dough. Okay?
I was waiting for a Joe
I know,
there
I thought I'd
or
have
so
one more,
or
but
something.
I ran out.
Okay.
I ran out.
Right.
I ran out.
Okay.
Hi, everybody. Don McDonald here, along with Tom Cock, and of course you. Thank you for being there, and thank you for listening to the show, and thank you for listening to our podcast. Those of you who do, remember we do have a podcast. You just go to your podcast thing and look for it. It's like bonus programming because not only do you get the show turned into a podcast, the Saturday show we do on Northwest News Radio, but you also get extra stuff. We do podcasts.
Well, we do 3 enterprise podcasts every week. So basically there's 5 podcast weeks. So if you really miss us.
Wait a minute. Enterprise podcast?
You know, like
the Starship Enterprise?
Enterprising. No, enterprising. Like, you know, I don't know. It's just, okay. Not the star. Never mind.
All right.
We do 3 more. So it's 1 every day.
I don't know.
Go for there.
The word enterprise. I didn't know we were doing enterprising. 855-935-TALK. That is a really, really important number because that is the only way during that entire process for you to actually have a conversation with us when we do this show on Saturdays. 855-935-TALK. And Bill in Maine has taken advantage of it. Hi, Bill. Welcome to Talking Real Money.
Afternoon, guys. How are you?
Good. Thanks for calling, Bill.
Yeah, so I've traditionally been a mutual fund investor in index funds, and I've become convinced that I'm overweighted to the large cap U.S. stocks, and I'm looking at reconfiguring my portfolio. But one of the things I've been wondering about is exchange-traded funds versus traditional mutual funds. I've usually been in traditional mutual funds and then talking about retirement accounts for my portfolio, most of it in a traditional IRA, though some of it's in Roth. And I wondered if in the tax-preferred environment, if there's a particular advantage to ETFs versus mutual funds, or does it really matter in that environment? I understand the tax advantages in a taxable account, but I'm a little confused about if it makes much of a difference in a tax-preferred environment.
No, frankly, it does not, because anything that they distribute or whatever happens there from a tax consequence doesn't matter, because, as you know, you don't pay tax on any of that till you take it out.
Right. So there's no advantage in tax-advantaged accounts.
And usually, if we're talking about Vanguard funds and other types of funds that are reasonable priced, is there that much of a difference or any significant difference between the management funds on the ETFs versus the mutual funds?
It's very, 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 very small. We're getting into such tiny numbers. We're literally, the difference between Vanguard's index funds and their comparable ETFs is in a few 1/100ths of 1%.
Yeah, it would be the reason I'd make that decision. I think your thinking is right. It's probably best from a tax perspective, depending on what your bracket is in some cases, to use exchange-traded funds in a brokerage or taxable type account. Mutual funds still do a very fine job in a qualified account. But when you started the conversation, Bill, I want to make sure that you finish your thought there, because what you said was you're a little worried about being too heavy in large U.S. companies, which is something I see on a very regular basis when I get to meet with people one-on-one. That's the part that concerns me more. I want to make sure you sort of build the portfolio out to other asset classes.
Yeah, you can then use ETFs to do that asset class building, and pay that 3 basis point difference or pay that 3 basis point reduction. But no big hurry to do anything.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Checked it out during the break, and Vanguard Total World Stock Index Mutual Fund is VTWAX is 9 basis points.
Yeah, and how about
VT? The ETF version is 6 basis points.
Yeah, so I mean, you really wanted to, save yourself every single. I know,
but it's just
then you probably would.
It's just pennies now on the dollar. Yeah. It's up.
And Bill, by the way, I have a main story. Do we have a minute? I don't know where we are.
I have another caller, but we can. What's your main? What do you have?
Well, my old man was stationed in Maine once. I think. Do you know this story? Real quick.
You have a place called. Because he said he was from Maine. It's spurred a main memory.
Yeah, just real quick. I mean, so he was.
Ladies
he was
and gentlemen,
stationed
welcome to Main Memories on Talking Real Money.
Oh, Maine, I like that with an E. He was stationed at a place called Loring Air Force Base back in the
I've heard of that.
80s. It's closed now.
Yeah.
But it was a SAC base, where they had the B-52s ready to go any moment, right? But the reason he was there, this is not a choice assignment. It's close to the Arctic Circle, I think. I mean, it's
What,
about
Maine?
the furthest north you get. Way up at the tip of Maine.
It's still not
far
close to
away
the
as
Arctic
No,
Circle.
That's a joke. But
okay.
the reason
It's
he was
like
there
you
was
living
one of
close
those
to Canada.
things.
Joke.
Well, I can see it from here. But the thing is, it was the reason he was there is because he was running a hospital, an Air Force hospital, another one at another base, and he decided that there was no more smoking in the hospital. This is about 1985 or something like that. And the wing commander came in and said, yeah, no, my pilots can smoke in the hospital. My dad said, no, they can't smoke in the hospital. And then the next thing my dad knew, he was at Loring.
He was at Loring.
It was one of those things.
Did he get moved from like Germany to Loring?
Yeah, pretty much. Yeah. See you later. So anyway, there you go.
You don't cross those generals.
Exactly.
855-935-TALK is the phone number to call us on Saturdays on Northwest News Radio from noon to 2 Pacific time. And we're going to head down further south where it's a lot warmer, actually still close to a SAC base. It's not that far. Baton Rouge, Louisiana. You have another story about that, Tom?
I do not.
Okay,
I do not
then.
have any
Michael,
Louisiana
welcome to
story.
Talking Real Money.
Hi, Michael.
What's up,
I have
Michael?
a question for you. To Roth or not to Roth?
That is the
I
question.
retired this year. Yeah.
I do have a Shakespeare
retired
story,
this-
having just been in London, if you want, but no, we're not going to do that. Okay, sorry. But tell us more, please. More. Give us some specifics.
Retired this year at 79 in a 457B. It's at Schwab, but I want to eliminate the middleman power and roll over all my funds to Schwab.
Okay.
Told by both Schwab and Empower that I have to liquidate all my assets
Yeah.
That's true.
for the rollover.
So you're coming
That's
from
true.
from your 457 over to an IRA at Schwab.
There's no tax ramification
Right.
to that either, by the
Right.
way.
But if you convert it to a Roth, there will be. So is that the question?
I do have a. Yeah, I've got a larger traditional and a smaller Roth, so I do have both types of accounts. Eventually, I was thinking about trying to do transfers into Roths for
Conversions?
beneficiary purposes.
Yeah, but
How old are you, sir?
you
I
said
didn't
79, you said?
I
Michael? You're 79, right? You're kind of cutting out.
Yes, sir.
Okay.
Yeah.
79. Not worth it.
No, I don't think so. Not that you're old at 79, but
Yeah,
I
but
don't
you are.
think it makes sense. Yeah, I'm sorry. No, I'm not going to say that.
You're older. You're elderly like
Okay.
us.
Yeah, that's true. We've crossed that line. So, no, I don't think that would be advisable. I think you move the money to an IRA. You said you already have one. Put it in there. Build the right portfolio. If you're leaving stuff for your heirs and they got to pay tax on it, well, it's money they didn't have in the first place.
Yep, that's my philosophy. No, I would not mess with it because it's going to be more work than it's worth because you must do some pre-planning from a tax standpoint to make sure you don't take too big an amount out of the pre-tax and put it in the Roth and kick yourself into a ridiculous tax bracket. So it requires planning, which means it requires cost, and the benefit is so negligible at this point in life as to make it unwise, I think, financially. It makes no financial sense. And it doesn't really make any emotional sense either because it's like cutting off our noses to spite our faces with taxes. We just want to avoid any tax thing, and we pay taxes to avoid them.
Your heirs are going to get the money. They're going to have to pay it out over 10 years. Pay the tax on it. Okay. Or you pay the tax on it.
Better yet, you spend it.
Okay, so just keep it in both the traditional and the Roth breakdown like I have it now.
Yep, exactly.
Yep.
Because they're out of the market, just get back in at one. lump sum.
Well,
Yes.
but you do exactly what you were doing before. If you had a 60-40 portfolio in your 457, then you immediately put it in a comparable, hopefully more diversified, less expensive 60-40 portfolio with Schwab.
They have to do that. They need to sell the securities there to move the money from the 457 to the IRA, unquestionably. But there's no tax. Again, it's a direct rollover, so you're not going to pay any. And
you don't want to play. You don't want to try any timing maneuvers here.
No, just the money goes in, build the right portfolio, and get on with it. Yeah,
exactly. Does that help, Michael?
I hope so. Been listening to you guys.
All right. Well,
and I'm a retired vet too, so.
well, thank you for your service.
I enjoy listening to you.
Thank you so much, sir. We really appreciate it.
I do have a Louisiana
855-935
story.
Talk. You have a Louisiana story.
I do, because I just was
Is it
at
about
Utah
an Air
Beach.
Force base?
Nope. I was at Utah Beach and I saw for the first
That's
time
not in
the Higgins
Louisiana.
boat.
That was in
Higgins
France.
Boat. Yeah, it was in France.
Oh,
And
the
it's
Higgins
first time I've
boats
seen
did come out
which
of
were built
Louisiana.
in New Orleans. Yeah, right. So there you go. It's obscure. But it's a reference
Because of the
nonetheless.
flat bottom thing.
Yeah,
Because they
could
could
go right
they could
into
go
the
in
and then
swamps.
drop the ramp and away you go. It's the first time I've ever seen one in person. So I've never been, and I still want to go to that great World War II museum in New Orleans. So someday I will get there.
For some reason, I thought, and someday I'm going to go to that great World War II museum in the sky.
Is that where it
That's
ends?
where it's going to be
ends up?
themed. Yours is going to be World War II themed. Your heaven is World War II themed heaven.
Oh God, that's horrible.
Well, no, it's likely. It's likely.
You can see the future now.
I can't see it financially.
But you can for my
for your.
Is there anything else I should know about in the more immediate?
No, you don't want to
future?
know. No. The other things I see, it's sad. It's just too dang sad.
Okay. Maybe at the end of the show, I'll jump in the lake, try to swim for the other side. That could alleviate the length.
We've got a break coming up, which is it's quick. It's one of those quick traffic breaks.
Yeah.
But do you have a quick question that we could take up after the
probably not. No, mine are all
you're not very
long.
well. You don't have any short questions. How is it that people? I get
they're writing books.
I get 30-second questions that are spoken.
How long do we have?
Well, after the break, we have like.
Oh no, I have one for after the break.
Well, I was going to have you start it before the break, and then we.
Oh, I see.
See, I was going to tease the audience into it,
one.
but that's okay.
I don't see the short one here.
You hear the
I don't
music?
see it.
See, music means you're running out of time. You waited. You delayed.
Screwed up again. So somebody needs to call right now so that we can put them on.
They're not going to. It's not going to happen. It's not. I just can look.
Sorry.
I'm looking at the screen. I can see. It's not going to be till next hour that we get another call. 855-935-TALK.
Tom and Don are talking real money.
Does it ever feel like you're a marketing professional just speaking into the void? Well, with LinkedIn ads, you can know you're reaching the right decision makers. You can even target buyers by job title, industry, company, seniority, skills. Wait, did I say job title yet? Get started today and see how you can avoid the void and reach the right buyers with LinkedIn ads. We'll even give you a $100 credit on your next campaign. Get started at linkedin.com/results. Terms and conditions apply.
For your real life and real future, Tom and Don are talking real money.
All right, I lied. I was wrong. My future predicting capabilities are obviously flawed. We do have a call. Let's go to North Carolina. Kent, welcome to Talking Real Money.
Hi, good afternoon, guys. Thanks for all you do. I have got two somewhat related questions here, I think. The first is, should the allocation be the same over all locations? And I guess what I mean by that is that if you have just a brokerage account and an IRA, you should have a 70-30 split in each of those.
No, and we can tell you why. If you can make it happen, it makes more sense to hold more stocks in, for example, a Roth, stocks in a brokerage, and then have the fixed income part, if you can, in the qualified accounts, like an IRA.
Okay.
I can explain
now,
why
that's
if you
not
like,
going
or
to
Don
work.
can.
That's not going to work precisely because you're going to end up getting out of balance sometimes a little bit if one portfolio has too much of one type of security. But just as a general rule, it could provide a slight taxable edge.
Yeah, I mean, you want the tax-free stuff to grow the most because it's tax-free, right? So that's where stocks go. There's no tax ramification or very little to holding stocks in a brokerage account. Fixed income is the wild card here, right? Because if you have fixed income in a brokerage account and you're paying tax on that, might not be advantageous. That's why it's better to have it in a qualified account.
And you have it
like
in a
IRA.
qualified account because eventually you're going to pay taxes, but it's at the same rate as you would have paid it if it was in a regular taxable brokerage account. So what's your second question?
Well, actually, that what you were just talking about dovetails right into my second question. Was that we have about around $100,000 that we keep in just a high yield savings account as kind of like an emergency fund. What I was curious, but we're having to pay tax on the interest that we receive on that every year. And my wife has an inherited IRA that right now we have to take out about $25,000 a year as the RMD. And what my real question was should we take some of that inherited IRA that we have in stocks now and move it, but just within the IRA, move it down to say like a money market fund to where when the income that comes off of that it stays in there tax deferred until we actually need it to help reduce our taxes right now?
Now, this is an interesting situation. This call was coming up right at the end of an episode on Saturday, and Tom and I were both a little confused. But I went back and listened again so that I could try to answer this during the podcast. And what it appears is that the caller is looking for a way to save on taxes, and I don't really see that this is a very effective strategy. You're talking about instead of continuing to have the money in the IRA in stocks, to have the money in the IRA in a money market account, and then to withdraw that money in lieu of having the high-yield savings account, which really isn't costing you all that much in taxes. And it again, I don't have time to get into more precise questions because I don't have you here. But if it is merely to save money on the high-yield savings account, it's just a way of switching emergency funds to the IRA. I don't see a big advantage. You're going to have to pay taxes on RMDs anyway whenever you take those within that 10-year time frame. But I just don't see a big advantage to giving up the higher return potential for equities in the IRA that you already have to take less money to avoid paying some taxes that you're going to end up paying one way or another anyway. In other words, I think you're looking for a free tax lunch or a tax-free lunch, and there aren't any. There really aren't. So I think we're nibbling around the edges here, and I would just keep doing what you're doing. And again, this goes back to our big issue, and our biggest issue of all with everybody who listens, and that is the importance. And this is not to sell something that we do. I'll give you the names of other firms if you want. You need to get a good plan because you need to know where the best places are for your money. This is why when you get to retirement, you can't do it on your own. I know you think you can, but most of you really, really, really stink at it because you get caught up in the minutia. And it's the big picture that really matters. Plans are critical at this juncture. Absolutely critical. I'm not the only one who says so. Vanguard says so. They've done studies on it. Christine Benz from Morningstar has recently come around on the same thing and said, no, there does reach a point where you must have, with something as important as your finances, professional help. So this became kind of a bonus podcast episode. We got a little extra in here at the end because we ran out of time during the show. And I hope that answers the question. Again, I don't think it's worth bothering with. Thank you all for listening, and we will talk to you really soon.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.